Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. This show gets you answers to all of your personal finance queries, and today I'd like to talk to you about returns. If you're using an application to invest, then you've probably seen the returns that your portfolio has generated in either green or red. Of course, if it's red, it's losses, but then hopefully you're experiencing a sizable amount of gains. But that's described in green, and you see something called Exire. And for those of you that are wondering what this is, it's not a simple calculation of your return. It's actually the Excel formula that talks about internal rate of return. Now, I don't want to scare you away, but I will tell you that we're going to talk about the internal rate of return, we're going to talk about rolling returns, and we're going to talk about point-to-point returns so that you can make sense of your portfolio. And also, when you study the various schemes that are out there for you to invest in, you can understand the best parameters to look at to decide before you invest in any of them. Join me to talk about all of this is Prableen Bajpai, who's the founder of FinFix Research and Analytics. Prableen, thanks so much for taking the time and for agreeing to do this. It's going to be educational for all of us, I'm sure. So let's first start talking about, if you don't mind, let's talk about internal rate of return, because I think a lot of people look at it and they don't necessarily understand what it means. Can you explain what it is?
Sure. So, Alex, there are definitely different parameters which we use for calculating the returns for mutual funds. And I think choosing the right parameter is very important because, so that we omit all kinds of bias which is there while taking our investment decisions. So internal rate of return, or the extended internal rate of return, is basically a formula which takes into account periodic transactions as well. So majority of the other returns, which we'll subsequently discuss, give us a point-to-point sort of a return, or gauge the returns on the basis of where do you start and then where do you stop, and they do not cover the journey. So it's really important that we use a parameter which covers the journey, because there will be different transactions. For example, an SIP going into your account every month, there may be a periodic withdrawal. So this Exire takes into account all of those transactions and then gives us the compounded return overall for the return journey. So it is one of the best methods to calculate or to gauge your investments, especially SIPs, because they are not having the same, every SIP will have a different lifespan. For example, over a 10-year period, if you're doing an SIP, some SIPs will have a lifespan of 3 years, some will have a lifespan of 9 years. So it calculates each and every point, the compounded return, and then gives us the consolidated picture for all of those transactions. It can also include lump sums which were added during your investment journey, as well as will take into account any redemptions which were done. So it's a holistic picture, and I think one of the good measures while choosing which fund you want to invest into, but of course not the sole parameter.
So just to, and just to elucidate this point, and I'm sure you have live examples, I want to throw out a hypothetical example at this point, right? So because you had the broader market indices, and here I'm talking about the mid cap 150 and the small cap 250, which in the start of the year fell by 20%, and then they recovered by 20%. So if you had a lump sum investment that you made in January of this year, then chances are that that has not grown by very much. It must be more or less where it was at the start of the year. If, however, you had an SIP, then your XIRR in that situation, or your internal rate of return, would be different, because you have installments that are coming every month, and you capture both the downside as well as the upside. Is that the right way to look at it?
Actually, Alex, honestly here, because we are looking at compounded returns for all these different time periods. Yes. And in fact, Alex, even after a year, sometimes it's not a, it can give us slightly higher or inflated numbers, basically. So I would say after 1.5 to 2 years is when the XIR starts to look more stabilized. And I think that is when investors should be focusing on it, not less than 1 year period.
Okay, so then let me change the hypothetical, right? So assume that you had a lump sum investment that you put at the start of 2023, and we're now in 2025, mid 2025. And then you didn't do anything to that, but then midway through you started an SIP, you pulled some money out. It takes into account all of those transactions that you've done and gives you a blended amount. So in a situation, your original investment must have given you 10%, but in between, with the markets going up and down, you could actually have gotten a 12 or 13% XIRR as well. Is that fair?
Absolutely, absolutely, Alex. So basically, it's the compounded return for every transaction that we are making. So it will take into account the timing and the amount of cash flows which are added or redeemed. It will reflect the actual returns experienced by the investor. That is the most important thing. When you're calculating your Exire, and it is your own investment, for example, you have an investment, let's say in a FlexiCap fund, and you've held it for a 5-year period. Your returns will look different from any other person's 5-year returns for the same scheme, because his investment period may be different from yours, right? It can be starting from 18, let's say, till 23. For me, it may be starting from 2020 to 25. So Exire is an amazing tool for knowing your own returns and making that comparison within your own portfolio, how your different schemes are doing, rather than comparing exactly different schemes. Of course, different schemes will also, over a same time period, give you an estimate how the returns look. But it's an excellent tool for gauging your own investment journey.
And funnily enough, Prableen, and people have studied this as well, the difference between having an SIP on the 5th of the month versus the 25th of the month, does that throw up a difference in the XIRR? At all? And there's not a dramatic difference, let's point that out. But you've identified a few schemes to talk about, and can you tell us about them?
Yes. So, there are 4 different measures, Alex, which we'll be discussing. So in terms of XIRR, if you're looking at, and let's pick the 5-year returns. So I've taken 4 FlexiCap funds, HDFC, Motilal, Parag Parikh, and SBI. So on a 5-year basis, the scheme which tops is HDFC FlexiCap with about 24.98% returns, and the lowest is 14.83 by SBI. So of course, within the same category, it is giving us an estimate on how the 5-year SIP returns look. 10-year returns are slightly different. HDFC becomes number 2. Parag Parikh goes to number 1, which was number 3 on a 5-year basis, and Motilal Oswal FlexiCap comes at number 3. But like we'll be talking about point to point, that is where, in the short time period, for example, a scheme like Motilal actually tops the chart. So that is why, gauging and analyzing all these different returns becomes really, really crucial.
About point to point next, because this is what a lot of people look to analyze whether or not a scheme should be invested in. And what you've just pointed out, the winners in the recent past become front and center. People tend to say, gravitate towards that.
Yes, the recency bias and absolute returns are our favorite, Alex. So to explain, the point-to-point or absolute returns is, I think, what most of us love to see, especially when it comes to real estate. For example, I probably, like a 50 lakh apartment becoming a 1 crore apartment, you're like, oh, wow, it's 100% return. And you totally miss out on the time period. Whether it took 5 years or 50 years for that return to be generated, that is totally missing from point to point or absolute returns. So it's a great tool for gauging the investment, but for a period less than 1 year, because 1 year we are not looking at compounding. So if you want to see what is the recent performance, how did the scheme perform during a certain dip, or how has been the recovery during a short period of time, Alex, this is the go-to instrument. Then absolute returns is definitely great. But if you're trying to see your returns over a longish time period, then absolute returns is a big no. So if we are looking at the formula here, it's like the ending period value minus the beginning period value and divided by the beginning period value, the basic formula what we studied during school. And for a scheme, for example, HDFC FlexiCap, if we just look at the absolute returns over the last 5 years, then the NAV actually went up from 570 to 2171. So it's like a 280% absolute return. And that is why we don't look at absolute returns over a 5-year period. This is over a 5-year period journey. But if you're looking at the 6-month period, for example, HDFC 6-month returns are 11.83. Motilal here becomes 14.17. So it becomes the topper in terms of absolute returns in a shortish time period, 6 months. Parag Parikh is only at 7.58, which was leading in terms of XIRR, and SBI now becomes number 3 with 7.79% returns. So it ignores any sort of fluctuation which happened during this time period. So no interim, importance given to what volatility happened, what sort of interruptions happened, doesn't account for cash flow in and out, and doesn't take into account the time factor.
Yeah, absolutely. You said it. And those winners and losers on a yearly basis will change quite dramatically based on the kind of tilt that a fund manager has towards one particular theme. And that is quite evident when you look at a patchwork over a period of time, Prableen. So the point is well made. Let's also talk about compounded annual growth rate. And that simply gives you a sense of how a scheme is done on an annual basis over a period of time, right?
Yeah, absolutely, Alex. You said it. And, just to go back to my example of real estate, I said that a 50 lakh apartment becomes 1 CR, it's
Yeah.
like 100% absolute return. But Alex, because the time element was missing from absolute returns, let's just, add and introduce time here. So if I made the same returns over a 6 year period, then my CAGR becomes 12.25%. But if I made the same 100% absolute returns over a 10 year period, then my CAGR only becomes 7.18%. And that is the kind of difference time can actually make. And that is why we give so much importance to time, because returns is one thing. In what kind of a time period those returns were generated is equally important. So it's sort of an annual return that you get an estimate of that, okay, maybe over a 5 or 10 year period. This is the roughly annual returns which are made by CAGR. So it is taking into account the time element for sure. But again, the beginning and the end date remains very important. Something which is totally taken care of by the Exire, what we had discussed earlier. So in this, again, beginning and ending becomes important. But it still gives us a standardization, a basic formula to estimate and compare different investments. And I think one thing which must be mentioned, that for most of the fact sheets and returns, Alex, that we see for mutual funds, if it is like 1 year, 3 year, 5 year returns, then CAGR is what is put there, the annualized returns. And when it is lesser than 1 year, then we are given the absolute returns. So it's a good method, but again, it is not taking into account the journey, the investment journey, if there are additions and deletions of investments during that time period. And just to give an estimate on the returns, for example, over a 5 year period, HDFC has given us 30.56% returns. SBI has given us 20.96. Over a 10 year period, when we are again, because here the returns are again dependent on the beginning and the ending period, HDFC becomes 16.74, SBI becomes 14.3, Motilal becomes 14.82. But it is one of the important ways to calculate and takes into account time and compounding, and good for generally having an estimate of returns of more than 1 year.
I find this very interesting. So if we can, at this point, I want to pull up both the CAGR returns for a 5 year period as well as the XIRR, or the internal rate of return for that 5 year period, and take a look at the differences here. Because you will see that the XIRR is quite different from what you've recorded as the CAGR. So for example, HDFC FlexiCap 30.56 is the XIRR, but the compounded, is the compounded annual growth rate, but the XIRR is only about 24.98%. So bear in mind that there can be a difference in your own experience of your investment and what you see when you look at a snapshot of the performance of a particular scheme. Now, the last bit, which is, I think, the most important when you're talking about the long-term performance, Prableen, of a particular scheme, and it's not always available, and this is rolling returns. And I want to spend a decent amount of time to talk about this, because this, in my opinion, is an extremely important parameter to look at if you have to judge the ongoing performance of a mutual fund scheme. Is that the right interpretation?
Absolutely, Alex. I think if you need to compare and see how the fund manager has performed and what sort of consistency the scheme has given over a long time period, I think rolling return is the go-to method. And that is what needs to be checked by investors whenever you are making a decision for adding a particular category, a scheme in your portfolio. So definitely. And this is why, because a rolling period is a way to evaluate the consistency of an investment over a time period that we choose. And it measures the different overlapping period as well. So it takes into account, it is not one specific date in isolation, which is taken for the beginning period and the ending period. So there is no luck factor here. So it's not like that, okay, maybe the scheme's NAV just went up by, let's say, a certain percentage on a certain day, and then the returns are looking better, or vice versa, because it is giving us a time period, long time period, and over that we are really covering the returns for every single day. So within rolling returns, Alex, the definition is that a rolling return is a way to evaluate the consistency of an investment, right? Over a time period by measuring the returns over these overlapping time periods rather than just a single, let's say, start date and end date. And here, what we do is that we define the window. So, in our example, let's say we want to see how these schemes have performed over a 10-year period. So, the time period will be 14th of, because till, till 15th of July. So, let's start with 15th of July 2015, going up till 14th, 15th of July 2025, the recent data what we get. Over this 10-year period, if we decide we need to check the returns over a 3-year rolling window, then we will start from seeing 14th July 2015, what was the NAV, and then we go, jump 3 years and we go to 14th July 2018 and we calculate the CAGR. Then again, we calculate the returns for 15th of July 2018, 15, and go to 15th of July 2018. So we are moving on a, just one day at a time, and we are calculating all those returns, and then we sort of put it together. And what we get is the average return then over this time period. So there is no chance that a particular day or is missed, or a certain event can actually make a difference to the returns. So it is like no luck factor here. It's almost taking like literally a road roller and just flattening the returns out.
I like that.
And it is one of the it's one of the best ways to give you an estimate.
So, but I don't. Before you get further, I don't want to drive home why this is important, Prableen, because we've all experienced it. A lot of people have experienced this. In, I want to say, March, April of 2020, when you had that very, very big dramatic drop in the equity markets, when the Nifty 50 went to just above 7,000. And if you had invested at that low point of 2020, just in the Nifty 50, and within the span of just 2 years or 1.5 years, yes, you would have made absolutely stupendous results and beaten any fund manager hollow just by investing in the index, which yes, is not necessarily a great, a great report card for the performance of your investment strategy. Would you agree, Prableen?
Absolutely, absolutely, Alex, because there is such an element of luck there.
Yeah.
You were lucky to have invested on the 23rd or 24th of March 2020. And we got this opportunity where markets were actually, Nifty at that time was down by almost 38%. So that worked in your favor. But if today I have to invest and see that where should I invest, again, picking the example of our flexi caps, then it is better that we don't get swayed by what has happened in the recent past and see the actual journey of that fund over this long time period where the returns have been flattened out, irrespective of whether it was the COVID fall or any other crisis which happened earlier. So it really tells you how the scheme over a longish time period has performed, and that definitely remains the better measure. So no scope for luck. And Alex, the returns here actually tell us that, for example, I'll have to take Motilal as the example here, because the short time period returns there look really good, the absolute returns over the 6-month and the 9-year period. But over a rolling period, of 3 years over a 10-year period, or 2-year rolling over a 5-year period, the returns are the fourth amongst these 4 schemes. So the returns are not, again, the scheme is not topping there. So it tells you that, okay, maybe that the scheme has really done well in the recent past, but that has not been the case over this 5 or 10-year period with consistency.
So a couple of points here though. Why 3-year rolling? why not 5-year rolling, and why not any other time period? Why is 3 years preferred, Prableen? And I know that a lot of analysts, a lot of advisors look at the 3-year rolling period.
So I think, Alex, the idea is to, so I've given you two actually.
Okay.
I've given you, when we're looking at a shorter time period, let's say a 5-year period, then we are taking a 2-year window.
Okay, got
because if you're taking a 3-year window, then we'll get very little data points.
Sure.
Because from 2025, when we have to see a 3-year rolling, then, the last data that I'm actually calculating is from 22 to 25. And we're not able to take anything further than that. So I think 3-year over a 10-year period gives us, a relatively recent data to capture. So for example, if I'm taking a 3-year window, I am also calculating from 2015 to 18, then 16 to 19, like that. And so I still have 2022 to 2025. So I think 3 years for equities is a good time period where we can see some returns, even if there has been a harsh fall in the markets. And if they have been, great returns in the past, then maybe again it is a time when the returns may have moderated. So I think 3 years can capture that rise and fall to some extent. Of course, 5 years even better. But then we don't have enough data points. Yeah. And for a lot of schemes, we don't have that sort of a lifespan. Still for them. So
that is what
I think,
my next question. My next question was going to be on that, which is that a lot of schemes have emerged over the last 5 years, and so in that case, would you be okay with a 5-year period and therefore 2-year rolling to judge the consistency of a particular scheme? Would that be enough for you? And what do you do when there is no such data? Is that the reason why you, as an advisor, would be more cautious about a relatively new scheme, about a relatively new strategy, particularly if you're not familiar with the way that a fund manager has managed a fund?
Yeah. So number one, Alex, if we don't have enough data, so of course, I think 5-year remains a good time period. We can even take 6 years, so whatever maximum possible. Let's say if I have to analyze 4 different schemes and the maximum common period for them is about 6 years or 6.5, we can choose that time period as well. I can use different rolling windows. I can use a 1-year, 2-year rolling window to give me an idea of how the consistency changes, if at all. And I think then we combine all these different measures. We also look at absolute returns, especially during the fall and the rise, Alex. I think that is really important. So how did these schemes fare when, let's say, from the 26th of September till 7th of April, when we actually saw that, Nifty at about 21,000 levels? From there, how has been the rise? And how have these schemes performed in sideways markets? And during the dips, let's say from October 21 to June 22, how did the markets, these schemes fare then? Because even that time, Nifty had fallen by around 16.5%. So I think performance then over different measures and different time periods. And if in case we don't have enough data for the particular scheme, maybe looking at how the fund manager has performed different schemes, other schemes where he or she has been managing the returns for a longer time period, that can also give you an idea. It's almost like if you have to visit Hayat, and Hayat in a new city, it's a new, let's say, hotel in the city, but you still know how Hayat is, operating in other cities, for example. So you can still get an idea of how services would be over there.
Good example, good example. Just a last question then, and you have described how you would read each of this data, right? And I guess to a certain extent, to elucidate the points that you mentioned, performance during a down cycle or performance as the market is in a bull run, you would look at elements like down capture ratio and up capture ratio to support all of this data that you're suggesting. So you don't take a decision based on any one parameter in isolation, but if you were to rank all of what we have spoken about so far and the way to judge returns, how would you rank it?
So if I have to see, other than the different parameters, Alex, within returns, I would give rolling returns like the top, followed by the SIP returns. If in case we are planning to give an SIP to the investor, I think then that also remains a very important. Absolute returns only to capture the recent movement and see the falls and the rise during times of drawdowns. And CAGR, I don't think is very relevant because it is only for the starting and the ending period. And if you're capturing rolling returns and if you're analyzing that as well as Exire, then I think we don't need to look at the CAGR. So those two at the top, followed by absolute returns for the drawdown periods, and of course the other measures like the standard deviation. What has been the risk-adjusted return? So for a certain, and rolling returns is able to give us that. That's the good part. It gives us the average returns. It also gives us the minimum and the maximum returns as well as the volatility, Alex. So I think all of these combined together, along with certain ratios that you've mentioned, like the up and down capture and Sharpe ratio or Sortino, I think all of these combined together give us a decent investment pool. Let's say we can really come down to maybe 2 or 3, and then check the overlap with other schemes in the portfolio and the investment style.
Fantastic. All right. Thanks so much, Pravleen, for joining in. Always a pleasure speaking with you.
Yeah. Thanks. Thank you, Alex.